Well, we've made it to mid-September. Want to bring you the latest data here in the Austin metro area. It is Fed week, and everybody is watching headlines. Federal Reserve expected to cut interest rates, their rate this week. How low will it go? These are the types of headlines consumers have been waiting on. They feel like we're waiting for the Fed. It's the Fed who's going to drive interest rates. And so we want to see what they're going to do. I've had this conversation ad nauseum, probably for 3 years, honestly. But the Fed did this last year. And let me show you why the Fed does not dictate what happens to mortgage rates. But before we do that, I'm going to show you what people call the dot plot. This is the Federal Reserve is not just Jerome Powell. It's a committee of Federal Reserve members. And so the dots represent how each member has kind of forecasted how they may vote. And so right now, the Fed rate is about 4.25 to 4.5. That's how they trade money between the banks. Well, they're expecting by the end of this year, their rate may come down about 50 basis points. So that would get us to 3.75 to 4, maybe by the end of the year. What's going to happen next year? They don't expect much. And again, this is all forecasting. The economy will dictate what really happens, but they're expecting maybe another 25 basis points next year and then another 25 basis points in 2027. So if you take the next 2.5 years, they're expecting maybe one full interest rate point would come out of the Fed rate. And so what is that going to do to mortgage rates? We don't know because the Federal Reserve does not dictate mortgage rates. They dictate short-term rates. If you've been following my videos, pop quiz, what does dictate mortgage rates? It is the bond market. So let me show you what happened last year when this exact same scenario came up with the Fed. So this chart down here at the bottom is not this year, it's last year. So when we got to last year, here's June, here's July, here's August, and what happened to rates? Down, down, down. They came down from over 7 down to 6.1. They dropped a full point. This is mortgage rates before the Fed made an announcement. They were kind of pre-forecasting that, the economy was going to slow down, inflation was going to start slowing down, and therefore the bond market was kind of getting ahead of the Fed. And what did the Fed do? They did what they said they were going to do. They lowered rates in September. They lowered rates a few more times throughout the fall. But look what happened right when the Fed made their announcement. I think it was around September 15th or 16th. Boom, rates started going right back up. In fact, within 1 month, they went all the way back up to 7 again. The Fed lowered their rate and mortgage rates went up. So why is that? It's because the bond market, which does dictate long-term lending, which is your 30-year fixed rate mortgage or 15-year fixed rate mortgage, what happened is they're looking at a lot more pieces of data. They're looking at inflation, which stayed sticky. They're looking at the job market, which stayed hotter than they expected. They were looking at the uncertainty in the economy. You had an election last fall, and you have global bonds that also all these different countries are trading, and national debt was still going up. So they want more return. So even though everybody this week is going to be watching the Federal Reserve, oh, they must have lowered their rates. Psychologically, it's a good thing. If the Fed is lowering the rate, people feel like money's going to get cheaper. And short-term money will get cheaper. But long-term money, your mortgages, the jury's out. We're going to have to see. Are we going to have another one of these bounce backs in the bond market? Hopefully not. I think now we all expect hopefully rates can stay lower. So let's take a look at where we are right now before the Fed. This is today's mortgage rates. This is actually as of Friday data. It'll change again today. But the 30-year fixed is around 6.29. That's pretty good. Call it 6.25. 15-year VA, FHA, they're all trending at 6 or below. So we're starting to see rates really come down. We were in the 7s. As we ended the spring, and that really kind of cooled the spring housing market. But I'm not predicting lowering mortgage rates is going to create a surge in demand this fall. I think it's going to take time psychologically for people to feel like we've gotten through maybe the bulk of higher rates, that rates are kind of going to consistently come down or get better. I think that's still maybe a 2026 story. But the good news is rates are coming down for the buyers who have made decisions to buy already in this market. You're getting ahead of the curve. So keep an eye on rates. Well, no shock here. These are the other types of headlines people are reading right now. 7 of the 50 largest U.S. metros, now buyers markets: Miami, Austin, Orlando, New York City, Jacksonville. So these are markets where there's higher inventory, months of supply, in Austin, we've had it for over 3 years. So we've been around this block for a while, but some of these markets are just now, maybe the last 12 months or so, trending, like Orlando and Miami and Tampa. Some of those Florida markets stayed a little hotter for longer, and now they're cooling off. That has to do with months of inventory. All right, well, let's look at what we've got going on. So this is August, the last full month we've had data. The red line is this year, and this is not price. This is number of sales. And you can see if you go back through the last 4 years, or 5 years, we're just seeing buyer sales just cool off. Not as many buyers each and every year writing contracts, buying homes. We'll see if we get back in line, maybe with these other 3 years, now that rates have come down some. Maybe we will get a few more contracts as we move into the fall. But for now, we are significantly below any of the last 4 years on that chart. The other thing I wanted to show you is, where is that putting us on price? Hang on, getting a little sticky on me. All right, so if we look at year-to-date sold data, so this is 2024 left column, 2025 middle column, and what's the change? So sales are down about 4.62% over last year. Average sales price, pretty neck and neck. It's down about 0.3% on the average sales price. Median sales price down about 2%, and that's year over year. So it's not collapsing, but what's happening is there's so few buyers, it's just creating lots of price reductions. Sellers that were off on price even a little, it takes a lot longer to get that buyer. And this is why we've got historical data. This is our active listings on the market. Right now, we have 16,200 listings. Last year, we had, at this time, 14,100. So we're 2,100 more listings than last year. 2023, we had 11,800. 2022, 10,900. So we're every year has just been adding. So as buyer demand goes down, inventory goes up. And the same thing's going to happen when buyer demand comes back. It'll start to get the inventory back in balance. So, more sales will tighten the inventory, less sales will raise the inventory. And so if we look at pending sales, same story in reverse. In 2021, which was the pandemic, 4,900 sales in August, 2022, 4,300 sales, then 23, 26, 2024, 24, 2025, 23. So we're just, again, every year we're seeing fewer and fewer buyers per month writing contracts. So we'll see when that trend changes. I'll be the first to tell you. All right, here we are in active time. We've got about 5.3 months of inventory, definitely leaning buyer's market. If we look at supply, obviously we've peaked for the year. It's starting to come down. But again, if you look at the gray bars, that's 10-year average. The dotted line is last year. We're still significantly above, as I just mentioned, last year. So again, higher on supply. If I look at the 10-year average on demand, we're actually doing okay compared with last year. Similar number of buyers and contracts, not too far off, but we're below the 10-year average. So again, less than average demand, higher than average supply. All right, we're going to look at real time. This is now active versus sold listings. The green are the active listings on the market. It's pretty clear now. We're on the backside of the bell curve, and we're starting to see, again, peaked in May. We're starting to see sales every month just incrementally coming down. I do expect if rates can stay low, maybe through September and early October, maybe we'll flatline instead of seeing sales go down. We'll have a few more sales. I hope that's true. That would be great news for the sellers in the market. All right. Well, if you are a seller in the market and you're already on the market, you feel it. You feel the days on market. You feel how hard it is to get showings. Any little objection buyers have can turn them off to your property. So it's really important to think through, how does this present to the buyers? Are they seeing projects, or have I, the seller, maintain this house in a way that makes it where the buyer feels like they don't have to do as much work? And of course, pricing ahead of the market, because the market is softening. It'll probably continue to soften through the fall and the winter. And therefore, you don't want to be in line with the competition. You need to be a little ahead of them, because they're about to price reduce this week, next week, the week. And sooner or later, you look up and all of a sudden you're overpriced because everybody else adjusted their price. So really got to watch that. If you can be a little ahead of the curve when you list, that really helps out. If you are a buyer right now, you kind of maybe have a nice little window here, assuming rates can hang in there and not jump back up like they did last year. I expect we're going to see, I'm hoping, rates kind of either go sideways or maybe continue to soften a little bit in the fall. That will help you. So not only are you getting a little better rate than anybody's had in the last couple years, but you're going to get a window where there's still plenty of supply on the market, but you're not going to have a lot of competition. And so that's really the game for you, is being able to buy, negotiate, and not have to have a lot of competition. Don't know what's going to happen next year if rates do stay lower. Anyways, hope this was helpful. If you want to follow our videos each and every week, make sure to go to our YouTube channel at Ryan Kelly Group. Click that subscribe button. And of course, if you know somebody looking to buy, sell, invest, or finance here in Austin, would love the opportunity to chat with them. Anyways, pay attention to the Fed. They're going to make their announcement on Wednesday, and I'll bring you the latest data next Monday. Thanks.